Economic indicators are critical metrics that provide insight into the overall health and direction of an economy. These indicators, such as GDP, inflation rates, and employment data, play a significant role in influencing stock market trends. Investors and analysts closely monitor these indicators to make informed decisions. This article delves into the various economic indicators and their impact on the stock market. Understanding economic indicators. Economic indicators are statistical data points that provide insights into the economic performance of a country. These indicators help investors, policymakers, and analysts gauge the current state of the economy and predict future economic activities. They can be classified into three types: leading, lagging, and coincident indicators. Leading indicators, such as stock prices and new orders for capital goods, predict future economic activity. Lagging indicators, like unemployment rates, reflect the economy's past performance. Coincident indicators, such as GDP, reflect the current state of the economy. Gross domestic product (GDP). GDP measures the total value of goods and services produced within a country during a specific period. It is one of the most comprehensive indicators of economic health. A growing GDP indicates a robust economy, often leading to a bullish stock market. Conversely, a shrinking GDP may signal economic trouble, potentially resulting in a bearish market. Investors pay close attention to GDP reports to assess economic growth and make investment decisions accordingly. Inflation rates. Inflation measures the rate at which the general level of prices for goods and services rises, eroding purchasing power. Central banks, like the Federal Reserve, monitor inflation to adjust monetary policies. Moderate inflation is generally seen as a sign of a healthy economy, but high inflation can lead to uncertainty and volatility in the stock market. Rising inflation often prompts central banks to increase interest rates to cool the economy, which can negatively impact stock prices. Unemployment rates. The unemployment rate indicates the percentage of the labor force that is unemployed and actively seeking work. High unemployment suggests economic distress, while low unemployment indicates economic stability. Changes in the unemployment rate can affect consumer spending and business investment, which in turn impact stock market performance. Investors consider employment data to gauge economic strength and predict future market trends. Interest rates. Interest rates, set by central banks, influence the cost of borrowing and spending. Lower interest rates reduce the cost of borrowing, encouraging businesses to invest in consumers to spend, which can boost stock prices. Higher interest rates increase borrowing costs, potentially slowing economic growth and dampening stock market performance. Investors closely watch central bank policies and interest rate changes to adjust their investment strategy.